Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey, everybody. Welcome back to the DIY Wealth Canada podcast. I'm Bob, along me with my co-host Nelson. Today we got a very exciting episode. We're talking about dividend investing versus income investing. So Nelson, what do you have in mind? This is a very interesting topic.
This is one of my pet peeves. And I hope that in talking about this with everyone, that everyone else will also have this as their pet peeve. Basically, my goal for this podcast is to make sure that everyone in Canada is annoyed by the same things I'm annoyed by. So let's do that today. Basically, my pet peeve is that there's dividend investing and there's income investing, and they're two very different things, but they get grouped under the same umbrella, especially by people who are opposed to dividend investing. So basically what I want to say is income investing and dividend investing are very different. Dividend investing is you have a company pays a portion of their profits back to shareholders in the form of dividends, whether that's a bank, a life insurance company, a utility, a REIT, whatever. It's all the same concept. It is the company's earnings you get a portion of. And then there's all these fancy products, whether they are Yield Max in the US, those are very popular. In Canada, we have a ETF company called Hamilton that's creating some similar products here. And so these are products that use various types of financial engineering, I'm going to call them, whether it's options, whether it's leverage, whether it's paying back a portion of your capital back to you via, as a dividend that really isn't a dividend, it's your capital. We'll talk about all these, kind of more detail as we go on. But the point is that they're two very different products that get grouped together, and I don't care for that. So that's what I wanted to talk about today.
Yeah, for sure. And I think there are some dividend investors per se. I'm generalizing here. They're like, oh, if I get dividend income regularly, like I get a steady dividend income, I don't really care about my principal, whether it goes down 20, 30, 40, 50%. I don't care as long as I get that steady income. But then on the other hand, you have dividend investors that want to collect that dividend income, and they want to make sure the dividend income is increasing by dividend payout increase, but they also want to grow their principal. I think both of us fall into the second camp, and really it's the first camp we want to sort of dive in a little bit more today, especially these fancy ETFs. Lately, we've been seeing a lot on Twitter or X or just social medias in general, because a lot of people are like, oh, I'm getting something like $10,000 in dividends a month, or even 20,000 dividends in a month. And then they have very little principal invested. And when you calculate the yield, it's absolutely insane. They're getting north of 10%, 20%, even higher yield. And is that sustainable? That's the key question we want to dive into today.
We were always taught as dividend investors where if you have a huge yield, anything higher than kind of 7 or 8%, it's immediately a red flag. And as an analyst, as a securities analyst, my job is to go in and look at that company and see if I can determine the earnings and whether the earnings cover the income. And it's like I'm talking about like this is a simple thing to do, but of course any securities analyst can tell you, well, that's not simple to do because predicting earnings is hard, or else, like investing would be easy. So from that perspective, it's like that yield has always been a red flag. And yet these income products, they regularly I'm going to say promise, even though that might not be the best word, but they're paying out these massive dividends. Like Bob, you said, 10, 15, 20%, and some are higher. And I think you share my concern is that these dividends are being marketed as safe dividends when we both know that those are the kinds of yields that should kind of make the hair on the back of your neck stick up. Like these are danger zone yields. And that's what I worry about.
Yeah, for sure. I'm just throwing names out there. We have no association with any of these ETF companies, but EOMax, Nelson mentioned, is a very popular one in the US. They have ETF, they have like cover code ETFs like TSLY, which is basically Tesla option income, APLY, which is Apple. They have a bunch, NVIDIA, NVDY. They have tons, like used to be only a handful, but now they have so many. Even they have a Berkshire option income, BRKC. And typically these companies don't pay dividends, but by doing financial exercising, like doing options, they're able to generate dividends to pay out. But one of the funds that EOMax has is called fund. They have funds of old funds, ETFs, and there's a ticker called YMAX, which is supposed to be fund of fund. And just looking at their website right now, it says distribution rate of 43.74% with a 30-day SEC yield of 88.53%, which is absolutely insane when you think about it. And there's also in Canada, there's Hamilton. They also have similar product, HMAX, which is similar to YMAX, but the yield isn't as high. And then they also have similar cover code ETFs, and it's really super, super high yield, north of 10% or even higher, right? Those are very, very scary in my opinion. Nelson, do you want to explain how they're able to get this kind of high yield with these ETFs?
Sure. And I'll focus first on these yield max products because, Bob, you talked about how they have ones for Tesla and NVIDIA and Apple and et cetera. The reason why yield max products are focusing on these tech stocks is because they're volatile. And volatility in the option market. So let's back up for a minute. So what's an option? Well, in this case, these funds are selling call options. So a call option gives you the right to buy the stock at a certain price at a certain date. So when you sell this option, you are creating a liability that forces you to sell this stock at a certain price at a certain date. And in exchange for that, the option seller here is getting a premium. So this fund is selling calls and creating this obligation in the future. But in the meantime, they get a income stream today. So because these are the most volatile section of the market, which tech stocks are, they go up more than the market when stocks go up, and they go down more than the market when stocks go down. They're more volatile, and therefore they have higher option premiums. So because of that volatility, investors are getting a higher option premium for taking that risk. Now, in exchange for that, they are creating this obligation in the future. And because of that volatility, there's a greater chance of hitting this obligation in the future. There's a greater chance of this fund having to sell the underlying stock to satisfy the option condition. So basically, all you have to know is that this option selling product is exchanging income for volatility, essentially, is what happens. Now, not only is there that happening, but there's also on some of these ETFs there is a leverage component on there as well. So Bob, why don't you talk about the leverage component and how they use leverage to kind of further income?
Yeah, so leverage, basically you're borrowing money to invest, right? So imagine typically when we invest, if you have $10, that's the amount of money you could invest. With leverage, you could borrow money. So say you have $10, maybe you could borrow 50% of that. So you actually have $15 dollar to invest. It's kind of a little bit like your mortgage, but it's a little bit different with leverage is you could borrow money, and when in a bull market, instead of say returning 20%, you're increasing that return because you're borrowing money. But on the other hand, when things are going down, you're losing money more as well. And a lot of these covered call ETFs or these ETFs that have super high yields, not only they do covered calls, they also do leverage, right? Some are 25% leverage, some are 50% leverage. The percentage difference a little bit here and there depends on the ETF. And by leveraging that money, they are able to do more cover calls to generate higher dividend income or distribution. And that's the idea, right? And that's why when you look at the ETF share price, there's definitely a lot more volatility. Like, for example, if take the YieldMax Tesla ETF, so TSLY, if you overlay the TSLY share price performance compared to Tesla, which is the underlying stock they're doing options on, you'll see way higher volatility on TSLY versus Tesla. And then that volatility kind of multiplies by the fact they're also leveraging on top of that. So yes, you're getting a huge amount of distribution, a very, very high yield, but your fundamental principle is taking a hit as well, which is kind of scary when you think about it.
Yeah, that's a great explanation. And it just goes to show how these products, it's basically risk on top of risk on top of risk. Every move that they make sort of increases the risk. They're picking volatile stocks. I mean, not all of these ETFs do pick volatile stocks. We'll talk about some in a minute that don't necessarily pick as volatile stocks, but these YieldMax funds especially, it's volatile stocks. There are, the options on top of them because of the volatility. And then you add on some leverage on top of that. And it's just, there's so much more risk here than the underlying stock itself. And, your investors are compensated for that risk through income. But I don't think the average person, Bob, who owns these funds really knows what they're getting into. They don't understand that the option income can be volatile, and they don't understand that by creating the covered call aspect of it, that essentially caps upside, but it does nothing to protect on the downside. So that's another reason why you see the the NAV erosion on these funds, because they're just designed for potentially that outcome. It's not necessarily guaranteed to have that outcome, but that's a consequence of adding in the covered call aspect of it and just the way that they're organized. I will too say that also fees on these funds can be quite high. I don't know, Bob, if you have any of those YieldMax things in front of you, if you can tell us what the fees are, but I'm going to guess they're somewhere in the 0.6 to 1% range. Can you see? Do you have those in front of you?
It's YMax is 1.28% gross expense ratio, so that's pretty high for sure. Now, I mean, that's maybe
quite high.
Yeah, maybe, and compared to like these index ETF, they're like fraction of a percent, like 0.25 or even lower. Now, maybe this is a generalization, but my view for these super high yield ETFs, it's almost like you're investing, say, $100 and you're just getting your money back as in the form of distribution. You're not really gaining money. You're just kind of, you put in $100 and you're getting $1 back every month. Meanwhile, your $100 eroding down. That's kind of how I view it. Sure, you might be able to time it and get a little bit more return, but ultimately my view is you're better off to invest in the underlying stocks.
Yeah, that's a great way to put it. I'm glad you brought that up, because that's exactly what happens. When you take a look at each of these funds, at the end of every year, they have to give a sort of a summary of what happened, like an annual report. And I encourage anyone who invests in any of these funds, whether it's the YieldMax ones or the Hamilton ones, which we'll talk about, I would encourage anyone to look at the annual report and just see where the money is coming from. They break it down for you inside the annual report. And what you'll find is a lot of times what will happen is we use Tesla as an example. So the fund will own Tesla shares. They'll write a covered call on that and they'll pocket the income. And then in the meantime, the Tesla shares go up. So what they'll do is, of course, this creates an obligation that the fund has to sell these Tesla shares. And what they'll do is they'll sell all of them, of course, because they have to, and then they'll buy back the majority of them, but there's a little bit of cash left over. And so what that is that's your principal that they're taking and they're putting it aside, and then they pay it back to you as a shareholder, as an owner of this fund, in the form of an income or a dividend. So you look at this and you say, hey, look at this income coming in. Wow, I'm getting 20 cents per share per month, whatever it is. But that's not income. That's your money that they've taken and put aside and then paid back to you in the form of income. That is not a dividend. That's you getting your money back. And that change or that distinction is extremely important for anyone who has these funds in their portfolio. You're getting your own money back. And my comeback to that is always when people talk about that is, look, I can create that fund tomorrow. I can just invest in something and then just slowly pay you, just slowly sell the shares and pay you the income from those share sales. It's the exact same thing. And I don't think the average person who owns these funds or, maybe we'll talk about them on social media, I don't think they realize that.
Yeah, and one thing to watch out, again, we don't have any association with these ETF companies, but I certainly have seen some, YouTubers or, call them fin influencers sort of pumping these ETFs, right? Saying, they're great and so on and so on. Just be a little bit careful when you see these, because, I can say for sure, but maybe the company's paying these people to advertise the ETFs, right? So just be careful. Ultimately, it's your money. You need to make sure you know what you're investing in. Don't just follow somebody on the internet saying, "Oh, invest all your money in this." Just do your homework.
Yeah, I think that if you can't explain what the fund does, how it makes its money to somebody in your life who is not a financial person, and I use my wife as the example, I always say to myself, if I can't explain this simply to my wife so she will understand, then I probably shouldn't own it because I don't understand it. And I think that's a good rule of thumb for anyone listening is if you can explain this to someone who isn't into finance and you understand it well enough that you can do that, by all means, then, you understand this product and you probably understand the downside to it as well. Bob, what about the Hamilton ETFs? I know there's a couple here that we wanted to talk about, but that's sort of the Canadian version of Yield Max, but it's kind of a little bit different. Maybe explain how they're different than Yield Max and sort of the different kinds of risks that they might represent.
Sure. So the Hamilton ETFs, they buy other Hamilton products and they kind of group them together as funds or funds. For example, Hamilton also has a yield maximizer ETF called HMAX. And that instead like TSLY where they only invest in Tesla and doing call options, it invests in, a few holdings like the Canadian banks, the Brookfields. I think just looking at the list of like financial companies and such. And again, it utilizes covered calls, and I don't know if they do leverage. I think they also do some sort of leverage. And then by doing that, they're able to generate additional yields on top of what the companies are paying in terms of dividends. So that's how you're getting, north of 10% for HMAX and these Hamilton high yield ETFs. Now, the fees are obviously a lot higher than your typical index ETFs as well. So that's something you obviously have to pay them for actively managing these high yield ETFs. Hey, so
Yeah,
Nielsen,
exactly.
we're only talking about the ETFs right now, but there's also split share corporation. That kind of structure is similarly to these ETFs. Do you want to talk about the split share corporation? Because I think they're able to provide quite a bit of high yields as well.
Yeah, split share corporations were in this niche kind of before these Hamilton ETFs were. The vast majority of these Hamilton ETFs are quite new. I'm looking at HMAX here, and it hasn't been around. I think it's been around for about 3 years, so
Mm-hmm.
they're quite new. So these split shares, what they did, and so Bob, you I think are a little bit more of an expert on split shares than what I am. I've just kind of saw the asset class and just kind of put it on my avoid forever list. So please correct me here if I'm wrong. But a split share, it's called a split share because there's a common share and then a preferred share. So the preferred share exists just to give leverage to the common share. And then the common share will use that leverage and invest in a portfolio of income paying stocks, and then they'll pay that income, that increased income that's been created by the dividend paying stocks and then the leverage on top of that. And they'll pay that back to investors as a outsized dividend. And so you can see yields anywhere from kind of 10 to 15% on that. Now, Bob, help me out here. There's an aspect in there with the split share that is kind of this wrinkle in the whole process, is there not?
Yeah, so I think the
Help me out here.
preferred share also has a finite term. Usually, it's 5 years. It's like any preferred share. There's a term, and then depend like the way it's structured. Like the Class A share, I think it's highly leveraged, right? So it by using leverage, they're able to produce a lot higher yield than your underlying dividend stocks. And then as a result, the day-to-day fluctuation or the overall volatility is a lot higher than your underlying dividend stocks as well. And yeah, it's like Class A, Class B, it's different share groups. And the other thing we haven't touched on is, again, I personally haven't really looked into too much in terms of taxes. I don't know if these high yield ETFs and also the split share, if you would get preferential dividend treatment when it comes to income taxes. I don't think you do. Like if you get, like, what I mean is, if you get a dividend from Royal Bank, for example, because Royal Bank already pay taxes on their profit, right? The dividends are paid from the profit of a company, because the dividend, there's already tax pay on the dividend distribution. You get a preferential tax treatment on these dividends. That's why it's called eligible dividend. I don't think these ETFs and split share distributions get that kind of tax efficiency treatment. So therefore, if you're investing in non-registered account, you may get hit by quite a bit of taxes instead of getting preferential treatment. Nelson, have you looked into how these are structured?
Bob, I don't know about the split share funds themselves, but I do know that with the covered call ETFs, because I have looked into how those are structured, and the answer is your income gets kind of divvied up into sort of three buckets. And of course, the one is return capital, which we talked about is sort of the bad thing. But tax wise is fine because, of course, you don't pay any tax on that immediately because it's return of capital, it's your own money back. But what that does is it decreases your cost on the product, meaning that you've sort of pushed this tax liability into the future. Not the worst thing in the world, but it's something you have to worry about in the future. And I don't think a lot of people who own these products realize that they are pushing this tax liability in the future. So then, of course, you have dividend income from the underlying holdings, which is, like Bob explained, it's taxed in a somewhat tax effective way. in terms of you get that dividend tax credit. And then the option premiums are generally taxed as ordinary income or as interest income, which is at your highest tax bracket. So what happens is that you've got this income stream that has tax consequences that are generally worse than a dividend income stream, and that you have to sort of compensate for that when you're looking at this. And from a after-tax perspective, your 12% yield might only give you a 8 or 9% yield after taxes, which is a pretty big kind of haircut from the federal government, who always gets their share. So that is definitely something for investors to keep in mind when it comes to these products. Now, I will say too, with split shares, I do know the preferred side of the split share is generally a eligible dividend. And I know that preferred shareholders, so there's a little group of us that sometimes talk about preferred shares on X or on Twitter. They are sometimes pitched as decent preferred share options because they do have the security on the other side of, this portfolio of kind of blue chip dividend paying stocks. The preferred share does have some security. It's the common share dividend that will get cut if the preferred share is ever in danger of missing its dividend there. So that's something to keep in mind as well.
Yeah, for sure. And you talk about maybe your actual returns after actual yield after tax is only going from 12% down to 8% or whatever the number is. The other thing you have also to consider is your principal. If you might not be getting, your principal might not be growing, it might actually be negative. So are you better off overall? Sometimes hard to say. But yeah, I think as an investor, you just need to watch out for these different types of securities. And if something looks too good to be true, just be careful and do your homework and research and understand what you're buying. Just because somebody's touting or pumping these security doesn't mean you should follow. Despite maybe these people have a lot of followers, just be a little bit careful.
Yeah, too. Bear markets always, that's where all the demons sort of come out of the closet. When we have bull markets and the underlying stocks are marching higher, if you have a covered call ETF that is, say it yields 14% and say 7% of that or half of the yield is coming from the covered calls itself. And then the other half is coming from the dividends from the underlying stocks and then some of your capital back. And that makes up the rest of that 14%. When the market's going up, it's not that hard to say, okay, I need to sell 5% of the portfolio every year to kind of give out as income, but it's okay because the portfolio itself is going up 10%. So the portfolio is going to keep going up and everything's going to, seem all fine and dandy. And then when a bear market shows up, all of a sudden it's like, the portfolio is not going up anymore and the portfolio might be down, 10, 15, 20%. And the leverage on some of these covered call funds mean that when the market is down 10%, the fund might be down 15% because of that increased risk the leverage creates. So the bear market is when things really start looking bad, and you have to be especially careful when that happens. And that's the danger, is that when things are good, nobody thinks about the downside. It's when things are bad is when, people have that, oh crap moment. What have I invested in? And that's way too late to start asking yourself those kinds of questions.
For sure. And I think, Nelson, you talk about how because part of the distribution is return capital, the NAV of these ETFs actually erode over time. And as a result, the distribution typically will drop. And I haven't really looked too deep into the overall performance, but I think if you look at the yield max ETFs, I think for the most part, again, need to do some more number crunching, but I think for the most part, the yield max ETFs, and I think part of and Hamilton probably true as well. These ETFs have have not outperformed the underlying assets in terms of total returns. So you kind of have to ask yourself, like, what's the point? You're just paying these guys to give you these arbitrary distribution as super high, but you're in a way kind of losing money. You're better off just investing in the underlying assets and you're better off. Right. So I don't know. That's my opinion. Nelson, what are your thoughts?
I agree completely. And now that we sort of understand the return on capital part and sort of that aspect of it, is I think that it's not terribly difficult for a individual investor to say, okay, I want a 5% withdrawal rate, 6% withdrawal rate, or whatever. It's like something that's a little higher than the 4% safe withdrawal rate that we all know and we've all heard so much about, because, hey, they just don't have enough capital in order to generate the income that they might want for retirement. That's why these funds exist, is because there are so many people out there who just haven't hit their retirement goals, but they have a certain amount of income that they need every year in order to keep the lights on at home and not starve. And I would caution everyone, or maybe encourage everyone in this situation, to say you can create your own products that don't have the downsides as these ones have, but you can sort of milk a little bit of extra yield out of them. And I'm saying yield, kind of in quotation marks here, because you take something like a Canadian dividend ETF, something like, what's the Vanguard one, VDV?
Mm-hmm.
And I believe that yields about 4.5%. So you can own that, get your 4.5%, and maybe you want a 6% withdrawal. So every year you might sell 1.5% of the ETF, and that gets you 6%. And for a few years, that's good, while the underlying ETF goes up. So if the underlying ETF goes up 5% a year and you sell 1.5%, you are still slowly increasing your stake in this ETF. So you're slowly increasing your account value, I should say. So you're essentially doing the same thing as one of these funds are, but you're not taking as much risk because you're finding more boring assets rather than finding some of the more volatile assets. You don't have a covered call aspect, which does limit your upside, as we talked about. And you don't have this leverage on top of that, which is going to make the underlying asset all the more volatile. So you can create not as much income, but you're still creating more than, maybe like the safe 4% withdrawal rule would indicate, and you're not taking as much risk. So there's definitely pluses to kind of doing it that way, and you save on fees as well. So it checks off a lot of boxes that we might be looking for. It's a tiny bit more complicated than just owning a fund and sort of punting that responsibility to a fund manager and just kind of collecting the income that they give you.
Right. That's a very good point. And I think ultimately, the way I see it is you can just like kind of quote unquote arbitrarily create yields without taking additional risk. So, like you said, Nelson, like 5%, it's already pretty high. Like north of 7%, that's where you can kind of get a little bit sweaty. But north of that, you're just taking on additional risk to get the additional yield, and quite often than not, is not worth it overall. So just be cautious, and I think ultimately total return is important. And another thing is you want your dividend to grow over time. Right? We all know about inflation. If you're getting $1,000 in dividends, but that dividend amount doesn't grow, that does you no good. And a lot of these covered call ETFs, the monthly payouts are all over the place. Because it just depends on the market condition. You may get a really big lump sum this month, but then next month you may not get as high of a payment. So something to watch out for. Nelson, do you have any other points?
Yeah, I think that's what we're ultimately saying, is that these funds have risk, and the risk is elevated. And likely a lot of people that own them maybe don't really understand how the risk is elevated. They just they look at kind of every dividend, every distribution is the same sort of stability, like they're all the same. And that is definitely not the case. There are more risky investments, more risky dividends or distributions in this case, because they're not dividends, than others. And that is fine if you know what you're getting into. But if your retirement is based on one or two of these funds being able to sustain these ultra high yields for a long time, just be aware that things can go wrong. And one thing I'll add is that, if you do need a little bit of extra income in your retirement years to make ends meet, a little bit of active income, a little bit of a part-time job or something can be very valuable. And not just financially, it gets you out of the house, it lets you talk to people, makes you feel useful again. I would much rather see someone do that rather than try to rely on a 14% yield, which might get cut at the worst possible moment. I would hate to see that happen to anyone. A lifetime worth of plans that just get thrown for a loop because a fund cuts its distribution during a bear market. That stuff is scary when it happens to people who kind of trusted the fund's ability to pay. Really scary.
Yeah, exactly. And I've seen people on social media where they may have a handful of dividend paying stock, like stable dividend paying stock, and then they start dabbling into these higher yield ETFs like the Yield Max or Hamilton, and then they kind of get sucked into this high distribution. They start shifting all their money from these individual dividend stocks that are stable into these high volatile ETF. That's very dangerous, because when you're putting everything in these ETF, like Nelson, you said, when things are going well, great, but when things are not going well, that gets really ugly. So again, I think if you do need that extra income, look for part-time jobs or something else. And if you really want to rely on these high yield ETFs to boost up your income, like dividend income, limit your exposure. Right? It all comes down to limiting your risk. Don't have 100%, 90%, 80% of your portfolio in these high yield ETFs. Maybe do, I don't know, 2%, 3%. I don't know what the right percent, but limit that exposure if you really, really want to go down this route. I'll be honest, I certainly had looked into these ETFs before and just like, oh, maybe we'll just put, a few $1,000s into them and we'll bump up our dividend income. But the more I research and read about them, and I just can't, because I just feel like it's better off investing our money in either a true passive index ETF or an individual dividend stock that I know better and I actually could understand a little bit better than these things they're doing with these cover call or high yield ETFs.
Yeah, I run into this somewhat often on Twitter, on X. Just the other day, actually, I put out a post on Imperial Oil, the large oil sands company here in Canada. I'm sure you're all familiar with it. And I was gonna I outlined sort of the reasons that I like the stock and I was bullish. And someone replied with, why should I buy that when I can buy I think it was a Hamilton ETF that has covered calls that can give him, I think it was 16, 17% yields. Why would I buy that why would I buy Imperial Oil when it offers a 2.5% yield when I can get this 16, 17%, whatever yield it was from this other product? And I see it all the time. And it's well, the answer is you're not comparing apples to apples. You're comparing apples to cheeseburgers, and they're just not the same thing. And that's really what I think we want to caution everybody on today. So, Bob, I think we're almost out of time. Anything you wanted to add before we go?
No, I mean, we could definitely talk a lot more. This is a very interesting topic. And we could go on and on. Just well, I want to again caution everybody, like when it's too good to be true, just be careful out there. There's so many different products available, and ultimately, it's your money. You should pay attention to your money and have the interest for your money. Don't just blindly follow somebody advice. And even between me and Nelson, like we may have our opinions and might not agree with you. So just be a little bit careful on what you hear on the internet and do your own research. Nelson, anything else to add?
I just wanted to add real quick here that I have analyzed these products before on my newsletter, and typically I get the most negative feedback out of anything that I do is when I do analyze these products. The people who own them tend to love them and don't really want to hear about the negatives. I think we're taking a bit of a risk here by having this episode, but the info is important, and I think that we have to get it out there because it's just there's issues with these things, and not just the people who own them, but prospective people who might own them need to know. That's important.
For sure. Yeah, totally 100% agree with you here, Nelson.
Good. Okay, so we are wrapping it up for this week. Bob, thanks for joining me as always. And I guess we will see you guys next time.
Yeah, until next time, everybody.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.